Hello, my awesome accounting students. Welcome to Chapter 5. Chapter 4 introduced and explained how to use the General Journal and General Ledger. In Chapter 5, we will learn how to prepare and record internal adjustments. Then we'll learn about how to complete and use the worksheet. Chapter 5 will also continue using the same General Journal and General Ledger to journalize and post the new adjusting entries that we are going to introduce in this chapter. In previous chapters, we have been learning what the accounting cycle is. Remember, the accounting cycle is a series of steps that all businesses must perform in order to have a good financial accounting information system. Let's review the steps now. The first step was to analyze the transaction. Think about the effect on the accounting equation, whether accounts are increasing or decreasing, and apply the rules of debits and credits. Step number 2 was to journalize the transaction in the General Journal. Step number 3 was to post the transaction to the General Ledger. In this chapter, we will learn about the next few steps in the accounting cycle. Way back when class started, we learned two major GAAP principles. We learned that revenues were recognized when earned, and expenses were recognized when incurred. These concepts make up the matching principle. The matching principle requires that revenues and any related expenses be recognized together in the same period. Of course, record keeping is critical to all businesses, large and small. So why does matching these revenues and expenses within the same year matter so much? If businesses were allowed to record revenues in one year and then postpone the recognition of their expenses until another year, their net income would not be reliable. We would not be able to compare businesses because they would all have a different scorecard. The matching principle ensures that all businesses follow the same set of rules and guidelines under GAAP, or Generally Accepted Accounting Principles. So adjustments are needed to comply with the matching principle. All adjustments will include an income statement account as well as a balance sheet account. What this means is if you mess one up, all three financial statements will be wrong. For that reason, the adjusting process is important. In the next section of the video, we will learn how to adjust for supplies that are used up and also for prepaids that have been used up. And we will also talk about how our fixed assets are used up or they lose their usefulness, a process that we will refer to as depreciation. Our first adjustment is for the supplies used up. As you've noticed in the first couple of chapters, the supplies account keeps getting debited. But we know what happens to office supplies. As time goes on, we use them up. The accounting records need to reflect this. So the challenge for this adjustment is to compute the amount of supplies used up. You do this by finding out how much is in the supplies balance currently, and then once an inventory is taken, you will know how much of the supplies are still on hand. The amount used up is calculated by taking what's in the account now and then subtracting out what's on hand. This will give you the amount of supplies used up. What do we do with this number? we make a journal entry to adjust. How do we do it? We debit supplies expense and we credit the asset supplies. Supplies expense is a cost of doing business, and now the supplies account will reflect the proper balance on the balance sheet. A reminder, all adjustments affect an income statement account and a balance sheet account. Let's move on to the Prepaids Adjustment. The prepaid account is an asset that holds amounts that are paid for in advance. In this example, let's assume we paid 4 months of insurance up front on November 1st. The purpose of the adjustment, just like it was on the supplies adjustment, is to determine the amount of the cost used up. Since the payment was made on November 1st for 4 months of insurance, and our current year ends on December 31st, that means that 2 out of the 4 months have been used up, or November and December. That means that we need to adjust the prepaid insurance downwards for 2/4 of $8,000, or another way of saying it is for half of $8,000. In this case, that would equate to $4,000 of prepaid insurance that no longer has value to it. So the adjustment that we need to make to record this amount used up is a debit to insurance expense and a credit to the prepaid insurance account. There's many kinds of prepaids. The adjustment works the same. This adjustment ensures that there is $4,000 of expired costs for insurance on the income statement, and notice there's still $4,000 of unused costs sitting in the prepaid insurance. Let's move on to the last adjustment, the adjustment for depreciation. Depreciation is the loss of usefulness of assets that normally occur as we use them up. Remember that the matching principle required that we match revenues with the expenses in the related period. When we buy equipment or a building or another depreciable fixed asset, we expect that that asset is going to benefit the company for years to come. Accordingly, the depreciation adjustment takes the cost of that asset and splits it over its useful life. In this class, we will be only learning one type of depreciation method. We will be learning the straight line method. In reality, there are many, many more types or ways of depreciating assets. You will learn about 4 ways in Accounting 101. The straight line depreciation method takes the cost of the asset, subtracts out the residual value, sometimes called the salvage value, and takes that amount and divides it by the life of the asset. This can be expressed in either years or in months. In this case, the cost of the asset is $11,000. The salvage value or residual value is assumed to be 0, and this asset has a life of 5 years, which is equivalent to 60 months. Let's compute depreciation. 11,000 minus 0 divided by 5 years is equivalent to 2,200 per year, or calculated on a monthly basis, 11,000 minus 0 divided by 60 months equates to 183 per month. The journal entry to record the depreciation includes a debit to depreciation expense and a credit to a brand new contra account called accumulated depreciation. The purpose of the accumulated depreciation account is to accumulate the depreciation as the asset is depreciated. It will help bring the asset's book value down on the balance sheet. Book value is a new term for us. Book value is equivalent to the cost of the asset less the accumulated depreciation. The second half of the chapter is devoted to how to utilize the worksheet. Let's go check that out.